Hi, everyone. Good morning. This is Jay Harris, lead support, and one of your instructors for these live trade sessions. I am not flying solo today. I am starting this off so that we can maintain our integrity, keep the start time as we have advertised, and that is a 10 a.m. Pacific, 1 p.m. Eastern time start time. Tom will be with us. He'll be with us.
Here.
Oh, there he is. I guess I don't have to.
You didn't think I was going to show up late,
I don't have to riff. I don't have to kind of ad lib or anything. We can just turn it right over to the boss. Here you go, guys. Tom Gentile.
Oh, all right, guys. Welcome. Wow, what a day. Let me see if I can find a good starting point here.
And I haven't done the disclaimer yet, Tom.
Say again?
I have not done the disclaimer yet.
Okay, that's a great starting point. Let me find my presenter screen. There we go. You should see us rocking and rolling right now.
Yeah, lead slide is there. Thank you.
Awesome. All right. Good afternoon, everybody. This is a historic day. You might wonder, why am I not screaming and yelling and worried about stuff? I mean, I'm worried about a lot of people. Let me tell you who I'm not worried about. I'm not worried about me. All right. I actually had a better. Last night. So I'm just gonna give you an idea of what's going on. Last night I'm at my brother-in-law's house. We got a whole family meeting, and it first started turning into a nice Sunday, but when the markets opened at 6 o'clock, it kind of turned where everybody was around the couch kind of talking about, all right, what are you in? What are you in? What are you in? And I'm going to tell you, we had people on the entire spectrum. We had people that were in, I had one of my family members was completely in cash waiting for something like this, and now he's ready to jump in. I had another guy, young, my nephew, who went super long the S&P on Friday, and now he is looking for money. And what I mean by that is he's looking to recapitalize his account. That's what he did, because the young guys in our group are all day traders, and he was trying to do an overnight thing, thinking that the same thing was going to happen this week that happened last week, where we get this huge rush of people that come into the markets again, and it didn't happen. In fact, the oil wars overseas are really the cause of, I think, half of the drop in the market today. And so we saw that kind of happening. But anyway, where did I fare on this? That's probably the big question. All right, so when the markets were down 5%, I was taking a look at my portfolio, and this is everything I got in my public trading. It was down about 1%. It was 1 to 1.33% was where I was this morning. And so when I looked at that, I thought, all right, well, what's working for me? What's not working for me? Exxon and USO and OIH not working for me. All right, because that was probably the majority of what dropped in my account. What was working for me was gold, and I had puts on gold that I shorted to try to accumulate more gold. That worked. All right, so I thought what we could do is we'll do a kind of a series on looking at, we're going to do a number of things. We're going to look at the overall markets. We're going to, I'm going to reiterate trading spreads. I want to show you guys a new spread today that many of you have never traded before. It's called a ratio spread. I'm actually going to put a trade on in USO. I'm going to add to a trade that I put on this morning, but I'm going to use a different month. I'm going to use different strikes, and so I can show you how this trade is placed. I am not recommending this. I want you to, if you've never done this type of trade before, I want you to understand it before you do it. But I will be putting it on in an ETF, and because ETFs have so much volume and liquidity, then I feel comfortable putting on an ETF and showing you how I put that trade on. That's the only thing I can find in the markets today. I tried to get long the S&P this morning, and I just could not catch a bid. I mean, I couldn't get, even when the bids and offers were there, they were changing so fast that I couldn't get my limit order to line up with the opposite of somebody else's trade. And it was sad, because it was a great morning, and it's setting up to be the afternoon. Even it looks like it's setting up to be the same too. Before I go any further, let me just let you guys know, for those of you who are here for the very first time, Welcome. Glad to have you here. We record these sessions. I'll have the recording out to you sometime this afternoon. You can ask questions and comments in the Q&A box there on the client side of where you're watching this. I'll let you know right now, we will not be able to get to all of those questions and comments. It's just not going to happen because there's just so many people in the room today, and I think a lot of it has to do with the historic day we got going on. Finally, the disclaimer you see on the screen. You can read this in its entirety on the recording that I send out to you. I want to mention two things before we get started. Number one, we all know stock and options trading has large potential rewards, but also large potential risk. All right, what you might not know is that me, Jay, everyone associated with OptionX and Tom's Trading Room, we're here as educators. We're here to show you how it is we trade. All right. I do that using my own systems and strategies, and I show you how I create low risk trades and how I plan, execute, and manage them. But I'm not a broker. I'm not an investment advisor. I do not give individualized or specific trading advice. And everything we're going to talk about today is in US dollars unless noted otherwise, which I don't think we're going to be noting anything else than US dollars today. All right, so again, welcome back to my OptionX students. Today we're going to start with a market analysis. We'll focus on spreads, and I want to show you this ratio spread today. Tomorrow and Wednesday, we're going to get into calendar spreads, probably the best thing we could be talking about, as we've just kind of hit an area where I think calendar spreads are going to be really sweet after today. And Jeff Beamer is going to be joining us to discuss calendar spreads. All of this that we're doing is on Tom's Option Tools. And for those of you that have never, that either have never looked at a subscription to Tom's Option Tools, or you have in the past and you just let it lapse, you can subscribe at tomsoptiontools.com. All you got to do is go above the login page, and you have subscription options right there. All right, so let's go ahead and get started. We're going to go into Option Trader. And I'm actually going to just look at some charts first. So let's do that. I'm going to slide over here. Here we go. Let me just log right back into Tom's Option Tools. All right, so here we are. And by the way, if you want to subscribe or renew, you can do it right here. I'm just going to go right in and click login. And I'm going to go to stocks, and I'm going to go to charts, and I'm going to go to stock charts. Now, TLT popped up because that's one of the ones I'm watching that's popped today. We're going to start with SPY. I'll come back to TLT. So here's SPY, and we all know of the big drop. What I want to show you is the implied volatility that came with that drop. So IV last month, and we're only talking maybe 3 weeks ago. All right, we were trading the IV was trading around 11 to 12. The IV today is at a 55. So if you think 11, the IV is 5 times today what it was last month. That means time value is 5 times more expensive for literally the same option with the same at the money expiration, for instance, or at the money with an expiration day of a week, 5 times more expensive. That's the big thing, the big takeaway here. Notice we opened down around 275. We're currently trading just around the 280 area as of really pretty much about 10 minutes ago. And we'll take a look at real time here in a moment. But there you go. That's what's happening in the markets as we see it. This almost looks like an Elliott wave move. Jay, you probably see that too, where we drop down. This could be an ABC correction. This could be the beginning of a 1, 2, 3 move, which means we have to have another pullback and another drop down. I believe that may be the case, as we've now hit and touched bear market territory. That's 20% off the highs. We're at them. We opened right around that area this morning. All right. What is the rest of the market showing us? TLT. Take a look at TLT. And Jay, I'm going to have you do the darknet money calendar stuff today. So okay. I'm just giving you a heads up there. But if you take a look here with TLT, so again, trading around the 140s, and it was moving higher for the year. All right, we saw it moving higher, we saw stocks moving higher, we saw the US dollar moving higher, and I made a mention last month that all 3 of these things could not keep going in the same direction, which is up. Something had to give, and I thought it was the US dollar it was going to give. unbeknownst to me, it was not only the US dollar, but it was also the stock market. All right, so both of those gave out, but we'll take a look at where they're trending today. This is interesting. So bonds went up, and bonds hit almost 180 this morning. Now keep an eye. We closed at around 167.5. All right, that was on Friday. We jumped at almost 180, and now we're trading at 175. Right, 180 was really close to negative interest rates. All right, we now have a almost certainty another rate cut's coming soon. All right. I also kind of wonder if Pelosi and Donald Trump are going to get together and maybe have a discussion that might involve a potential bailout. Okay. Or some sort of stimulus package, not a bailout, some sort of stimulus package that could further add liquidity into the marketplace. Because they haven't talked in months, but they may have to have a ceasefire, and we'll see what ends up happening. But in any event, that would alleviate the pressure that's happening in bonds right now. UUP is the U.S. dollar. U.S. dollar had a very interesting. Remember, it was hitting highs for the year as well back in mid-February. It too pulled back. It pulled back as I expected it to pull back, but I didn't expect all of this to happen. But today was interesting. We opened, we dropped down real quick down here when the markets went into their circuit breakers, and then we pulled right back up. But we're still trading lower than we opened today on the U.S. dollar. All right, so that's an interesting one too. When we run into situations where I haven't seen a move like this. My son was asking me when did you see oil move down 30%? We were talking about it last night. I said, I've never seen oil move down that much, but it did in the Gulf War. And that was 1991. Okay. I was not looking at oil at that time. I didn't remember that move, but I certainly remember the move that happened last night. But what I'm saying is that moves like that are going to cause things to just kind of go out of control. And that's exactly what ended up happening here with UUP. Let's take a look at USO, the biggest mover of the day so far. And we're seeing USO dropped down quite substantially. We were trading at 672, the low, 672 for today. We're only at 701, so we're not that far off the low. But this is telling me that, and this price action is telling me that potentially a rally is not going to happen anytime soon. All right, so I want to set myself up where if we get further down, that it actually works out in my benefit. And I'm going to show you how I'm going to do that here a little bit later on in our program. So stocks, bonds, currencies, commodities, what's gold doing? I think gold is probably the most frustrating thing that I'm watching. And this is why, because I saw gold pull back last week. Or the week before last. And then for the 5 days, Monday, Tuesday, Wednesday, Thursday, Friday, gold had a nice rally. And GLD went from about 149 to 150. It was at 159 on Friday before pulling back. But then I saw this pullback. We get up here to the high 150s. And what's going to push gold higher? I think what's going to push gold higher and get it above 160 is going to be the next rate cut. That's what I think is going to push gold higher, because gold just can't get there on its own. People are not looking at it as safety, as maybe just getting to cash, selling out and buying U.S. dollars. Selling stocks, buying dollars. It seems to be selling commodities, buying dollars right now is, I think, the trend for the short term. Add all this up, and what we see is potentially. Our markets are, chances of going back up and hitting all-time highs this year just went very low. All right, we're in an election year, and it's a really weird election year, and so I think that's going to cause some nervousness. And then you've also got now oil dropping down very low. That's going to end up doing what? If you look at USO, I also look at OIH, which are the holders, the oil holders. Oil holders are down substantially. We're down to 521, all right? We were at 8 on Friday's open. And so to go from 8 down, I mean, this is a 40% change from yesterday's open to the current prices of today. That is insane. That tells me a couple of things. Number one, if you're working in shale, you may not have a job real soon. Number two, if you work for a smaller oil company, you may be working for a bigger oil company in the near future, and you might even get laid off after that, because I think this is going to be one of those opportunities where companies like Chevron and Exxon are going to mop up these small guys because they're just not going to be able to handle the kind of drawdown that happened today. All right, so those are some things we have to think about too. Again, I don't think this is going away anytime soon because now we've got potentially job losses that are going to happen in oil and energy, transportation, service industry. You know, Florida revolves around two things right now. Construction. The state of Florida has all their marbles in construction and tourism. And right now, tourism just got wiped off. I mean, if there's any time you want to visit Disney, now's the time to do it. Unfortunately, you're not going to want to go because, you know, other people will be there. But it's interesting that that Disney here in Florida is probably, you're finally going to be able to get, you won't have to wait in line to get on any of the rides. The problem is it's going to get to a point where Disney's just going to shut down because it isn't going to make sense for them for a certain amount of time and kind of have a grand reopening. So that's going to put some folks out of business, and the businesses literally in Orlando, a lot of the service industry is going to just kind of go to the wayside. But what about the construction industry? I think the construction industry is going to continue to boom because with lower interest rates means refis on existing homes. But it's also going to mean that new home purchases are going to skyrocket because people are going to now see the ability to get into a home and do it with a really low interest rate on a mortgage. So there is going to be some cause and effect that's going to happen here. All right. If I look at something like a Home Depot, for instance, all right, haven't looked at these yet. Home Depot's making a low. This is home improvement. All right, we know that. It did drop down to the lows that happened just a little more than a week ago. All right, we'll see where this ends up going. What about Lennar, which is one of the biggest home builders out there, LEN? Right, they've dropped down too. But again, I think that this might be longer term, might work for them simply because while we will see people stop purchasing, people still have to live in houses. We still have to have a place to hang our hat. And those who are renting might see an opportunity now where instead of renting, home ownership might be an opportunity because interest rates are at historical lows and are going to be even lower when the Fed makes that next cut, all right, for mortgage rates. So those are some possibilities. If I were to look at what's going on in terms of the day, all right, so this is the SPY. Here's where we opened at this morning. The low was 273.50. This was right at the circuit breakers. And then we moved up and we got above the first hour high. We pulled back. Now, what could make us go up versus down? Well, we've been up here once already. We could make another rally to the upside and move higher. And if I look at TLT, well, TLT was suggesting, and this was right at an hour ago, that we were likely going to move lower. But look what TLT's done since then. We've gone from 174.30 to 178.08. I've never seen these kind of moves happen. But this is going to put pressure on the market. The other thing that's going to happen, and no one's talking about this yet, or if they haven't said anything in the last hour or so, margin calls. All right, there are companies, there are hedge funds out there, there are large specs out there, and there are probably a lot of small speculators too that over leverage coming into today, and some of them are going to have to get out, and a lot of the small guys ended up getting out this morning. You see this? This is where they got killed this morning. The larger operations will have to clear out maybe by 3 o'clock, right? So that's going to put some pressure on the stock market. That potentially we may see this go lower. All right. So that's and that could happen here in the next hour and a half. We could see lower S&P prices. I'm not a trader on, I think something's going to go down, therefore I'm going to sell, or I think something's going to go up, therefore I'm going to buy. I don't trade like that. You guys know that by now. All right. I'm just speculating on what could happen based on some patterns that I can't quantify. I can't quantify these type of patterns because they don't happen that often. All I remember is the last time we had this kind of a move, the margin, the traders on margin had to exit their positions. And a lot of margin traders were long the market because of what happened right up here. This right here that happened on Friday from 3 o'clock to 4 o'clock, we moved up from 290 on the S&P to almost, to 298.5. And that was that furious rally that everyone was talking about in the newspapers. And a lot of people got on board there at the close thinking, hey, I remember what happened last weekend. We had follow through on Monday. Nope, that didn't happen. We had this on Monday, and they had to, a lot of the guys that couldn't afford to stay in longer than the morning were forced to get out. Those that are still in, that are in pain, are going to have to make some sort of decision by the last hour of the day. And their decision may be, let's start cleaning out. And that could push us lower. In fact, we get below this area right here, this 278.64, 65 level, which might happen here in the blink of an eye, then that might push the new wave of selling to come in. This right here is telling me, right here, bond market in the last hour is telling us stock market wants to go lower. We'll see. Bond market could be giving us a tell for the stock market. We will see. All right. So that's stocks and bonds in terms of looking at the short term. And we can get into trading spreads. I think what'll happen is, we discussed trading spreads on Friday, and all of you got the recording on Friday. So I don't want to go through trading spreads again so much. I think what I want to do right now is I want to turn this over to Jay, and I'm going to let Jay talk about Darknet and talk about Money Calendar and trading spreads in that. And Jay, the area I would like you to go into also, once you get into Money Calendar, is take a look at the ETFs and show those people that have access to the Complete Trader how to get to the Money Calendar ETF while you're at it.
Okay.
So let me turn this over to you. Are you ready?
I am ready.
All right. I found you. Here you go. You now have the controls.
And my
I see your
screen
screen.
should be up. I'm on the.
I see you.
Okay, good. We're on the weekly money page. Somebody requested this, Tom, and we can go over this.
Okay.
Somebody's also stating, why aren't we doing more put trades? Well, the scans we've showed you.
Why didn't I see this coming 2 weeks ago?
Right. Where's that crystal ball?
I actually kind of did. I mean, last month I was actually saying I'm going more to cash.
Sure.
All right.
Sure.
And any of our tools guys who've been in here every day, we did the February challenge because we've been here every Monday, Tuesday, and Wednesday for the month of February. They know this already. All right. Yeah. But to actually physically go short or long while the market's falling apart, it's hard to do. I mean, for instance, I was trying to go long this morning because I had a pattern that started at 10 and ended at 12 in the S&P. I could not get anybody to take the other side of my trade because the bids and offers were so wide, and I wasn't going to do a market order. So, I am doing, and I could be looking at put options this afternoon, but I don't have any signals. I just have thoughts, and I don't trade thoughts.
And that's where I was going to go. Some of these scans are bullish scans, so they're not going to be used in bearish markets. Over the past few weeks that we've been doing these sessions, the sections I've been doing have not been done to show you exact trades that we're doing or recommendations. It's tools, navigation, and training as to how to use these scans, find the setup, then how to use the options analysis tools within the tools to find an option trade on that. And then if you wanted to do that on your own, that was up to you guys to do so. But like Tom's been teaching, minimize the quantity of trades that you take, the position size, and keep your stops a lot tighter and such. So we'll show you a couple more bullish scans. Money Calendar is set up to do both bullish and bearish. But folks, we've been in a historical bull market, 10, 11-year bull market run. So there hasn't been a lot of bearish setups where the stocks have traded down. 9 of the last 10 years. And those that are of a much shorter term variety. And you can say, well, I mean, the markets are dropping so fast, so quick. Who would have predicted a 20% drop in the markets in the tune of 10, 11 days? So, you know, it's one of those things where it's like in hindsight, yeah, we should have or could have, but that was not our reality. So we'll go into this. We had the request of the weekly money calendar. Actually, let me rephrase it. It's not the weekly money calendar. You'll find in the home in Tom's Tools, you'll see that you have the money calendar, the money clock, holidays, and weekly money in the Complete Trader, and you presume that it's a money calendar type scan, but it's not. Weekly money, folks, is more similar to the darknet scan. It's looking for multiple channel collisions, and we're looking for the price support on those multiple channel collisions. It's not the exact same algorithm as darknet. It's not the exact same thing. So we may find something here in the weekly money, but then we can go to darknet and we won't see anything there. And that's because they're not the same thing. So out of all the money calendar type scans here that are not technically based, the weekly money is. So when we click on weekly money, we're really only going to use this on Mondays and Tuesdays of each week. And for the Monday selections, we're looking for this move to bounce higher within the week. So we're looking at a Friday expiration for the options. If you're looking at a Tuesday of the week instead of the Monday, because of the back test and the results that we've seen from the back test, and this was developed by John Broussard and put into the tools, and this is what the back tests he's run have shown, that the best options expiration for a Tuesday trade is the following Friday. So if you're making notes, we are at 27 minutes after the hour from when we started that we're stating weekly monies for Monday trades or a Friday, this Friday expiration. Tuesdays are for the following Friday expiration, and those are the only 2 days that we pay attention to this. Okay, so I'm going to go back to Monday, and over here is the wizards, bullish or bearish. Whether they be a bullish or bearish setup, we're looking for bullish best, bullish good, or bullish best or good. So if you go up to the top and you click on the help button, you'll bring up a help tutorial page, and this explains the weekly money help page. It shows you the screen images from where you were before and a breakdown of what each of these items in this page are showing you. And specifically when it comes to the bullish best or good, let me find that section here. There you are. Okay, the best scanner is looking for the back-tested performance. These have the better trade results, but they don't have many trades. Okay, the good trades are more trade opportunities, but they're not as good a return as the best patterns. But you can do bullish, best, and good and get the combination of both in there. Okay, so let me go back to the screens and the scans, and here you are. We're going to go to the weekly money, and again, this is not the same as the calendar where it's looking for time and price moves. Okay, it's looking for the channels and stock prices at channels. So we're going to leave it as the default, bullish, best, or good. You can leave it on the weekly stock list. I'll go to pennies and weeklies. We're ranking based off the slippage. You can go percent to double. Let's go percent to double and then left click on search. So when we bring up the search, the list results show us down below here the opportunities. Okay, here's your percent to double rankings. The lowest percent to double right here comes in as Mondelez. Okay, MDLZ. It's a $54 call, price of 93 cents. So it's less than the $5 per contract. If you want to check out the channels, click on the channels and you can see here, it's looking at 3 channels, a short-term channel, a parallel or medium term, which is color-coded in yellow. The shortest term is green, and the longer term is more of a magenta, pink, or red, depending on your screen colors. So here we see that the price is stacking over these, at least a double stack for right now. We have the parallel and the longer term support being tested by the price. A little bit further down is for the shortest term, and then we're also coinciding with some kind of price support back in here. Okay, so you can left click on that chart to make it disappear. Then if you like the idea of that particular trade, you can go and left click on the trade leg right here, the March 13th. Again, this Friday's expiration, $54 call at 93 cents. bring up your risk graph on that. You can check out what it needs to double from price. You saw the percentage, about 3.24, 3.3%. So it needs to be at 55.86 by this Friday to show the prospects of a double. Okay, so 55.86, where is that? It's roughly right in here. See if I can hover over that and get a price to show up. The high 55.48, so just a little bit shy of the 55.86, but it's been higher than that recently. If you think this volatility could pop this stock a little bit higher to that, there's an option you can contemplate. If you think that the market's still too volatile, we don't want to wake up with another 800 to 1200 point down day that you want to stand aside. We fully respect that, but that's the education on how to use the Money Weekly. Okay, go back to your Money Weekly page, leave it on bullish, best, or good for Monday, percent to double or any other trade sort method, run your scan and make your decisions accordingly. Any questions on that before I move on? Let's take a look. The spread is wide on Mondelez. Okay, if that's the case, then you stand down. What is the bid ask? It's 24.34 cents. Okay, that's greater than 1%. 1% of 54 is 5 cents, and that's 34 cents. If that's too wide, you stay away. I'm showing you the education as to how to navigate this tool to find the setup, find the trade, and then it's up to you to go forward. I'm not saying to do this. I'm not even going to save this as a paper trade, but I have provided you the education as to how to do this, correct? That was the goal. That was a request. I think we've met that. All righty. So now let's go to Darknet. Darknet is not the same thing as weekly money. It's similar, but it is not the same thing. So we will go ahead and go to Darknet. I like to bring up the call option trade sort right away. So that way, if I like the chart, I can then go ahead and look at the option that has the lowest percent to double. But what do we have here today? Tom, there's nothing there. Why do you suppose it is? We're looking for a retracement within an uptrend. Have we had an uptrend? We've had a 4-day bounce. You know, as of last week, we were looking at a prospect of a V bottom, but the reality, that was not a V bottom. That was a rollover. So that's like Tom's saying, this is possible. Elliott wave continuation to the downside. What were you saying, Tom? I'm sorry.
I said, you're right. There's nothing there.
Nothing there.
Nothing's triple stacking. And we don't have long, short, and intermediate, channels connecting right now because everything's gone wild.
Yep. It's look out below. I even went to the candlesticks and we did a 4-day back test. Not a 4-day back test, but a 4-day back search, meaning over the last 4 days, were there any darknets with a candle? Nothing. That's how precipitous this drop has been in the marketplaces. At least for Darknet, no opportunities there. So we're going to move on. Now I'm going to show you Money Calendar. Money Calendar does look for bullish and bearish setups. We are looking for a positive power meter. So when we go to Money Calendar, we double left click on power meter to rank by positive power meter to lower. It will find bearish setups if they're there. Are you seeing any? No. Finally, down here, CF. But the concern is it's only a 12-day trade. We like these of the 20 to 30 days out. And the best way I can explain this, folks, is again, that historic bull market. We have not had 9 out of 10 bearish swings in prices on stocks that are, of the variety of 20 to 30 days out. And Tom, I'm finding some that are 20 and 30 days out on the bearish side, but their power meters are all negative. See there?
Right.
I mean, there's TBT, there's Mosaic, but look at the power meter. I mean, the profitable moves to the downside haven't been that robust over the 10 years. They may be now, but we're not going to, try to make exceptions to the rules. So we're going to stay disciplined. And as much as we'd like to be in bearish trades based off this, folks, our setups just are not coming in and giving us the ideal setup for us on these bearish trades based off Money Calendar. So we can't, okay? The one that we're looking at as a bullish opportunity is one that you take an additional assessment on. And the additional assessment Tom and I were talking about over the weekend was on Costco and on Walmart. But when I was looking at the Walmart trades, there wasn't a Walmart spread that looked ideal and that didn't have, you know, wide spreads that were giving us the ideal setup. So, you know, we talked about Costco and showed it to, you know, other groups and other folks that we talked to, and I'll show it to you here as well. It's COST. The reason we liked Costco in this market, and you can look at the chart, Costco dipped, fell apart, dumped, just like many others did because of coronavirus concerns. But if you look at the chart, what has it done recently compared to all the others that are still continuing to just drop like a rock through a plate glass window? Let me bring up the chart on Costco on my other screens here and all. You guys can bring up Costco on your screens. You know, since that dump at the end of February there, it has bounced back up. It ran into an earnings announcement 3 trading days ago, went a little bit sideways on that, but it has held up and it has bounced back pretty well despite these coronavirus concerns. And why do you suppose that is? You know, who's going to see the influx of money? You know, we're talking about chain supply, you know, how the coronavirus is disrupting, you know, supply chain and all that kind of stuff with many of these companies. It's going to affect their earnings. Maybe it does for Costco, but Costco had a blowout quarter, but who's to say what's going to happen in the next quarter? But when you need to buy toiletries, water, vitamins, where are you going? If you've been to your local Costco, maybe you've seen it like mine. These shelves are getting torn apart, man. There's like no supplies left on the shelves. We've got local supermarkets, folks, limiting the number of top ramen packets you can buy. You cannot buy more than 5 packets of top ramen. It's just the surge of people going to, you know, these super warehouses, these super grocers to stock their shelves because of, you know, the coronavirus and concerns and preparation for when it hits their neighborhoods and such. So here we are looking at Costco because its chart is holding up. Fundamentally, we believe that it is a stock that is, for lack of a better term, kind of reaping the rewards of the coronavirus. I mean, it's the company that people are relying on and going to for their products, goods, and services and such. And so we're going to take that approach to saying that this is one that may be viable for that reason, plus the money calendar set up here and all. So I'll get into the ETFs, Tom, as you requested, but let's take a look at Costco real quick, folks, because this is what we want to do. This is not a recommendation for this specific stock, but when you find something that you feel confident in moving higher, it has an end date of April 3rd. Now, that's not the standard third Friday expiration. We would like the April 17th, but let's look at the April 3rd, and if there's something there, maybe you entertain that. But the end date is April 3rd. Options expiration is also on April 3rd. Let me confirm that with the calendar here. There you are, April 3rd. You can go 2 weeks further out and have, you know, more liquidity and maybe tighter spreads because of that. Just remember the end date is the 3rd though, okay? But let's take a look at the April 3rd as well if there's something there, because we typically want that expiration or the expiration just past it. But if the slippage is too wide because of these weeklies versus the standard third Friday, the default would be to the standard third Friday. But we want to look at the information and we want to write this information down. So you write down the stock ticker symbol, COST. You write down the price. Last I looked before I started talking was 306.97. If y'all are fine with that, I'll keep it at that price, 306.97. The average profit move is 321. So add 306.97 to 321, and that assesses your target price. That if this stock just does its average move that it's done over the past 10 years, 321, we should see Costco at 310.18. So 310.18. Okay. So now we then go to our options analysis page. And I ran the searchers, find trades. I changed the symbol to Costco, bullish assessment, less than 45 days, and the bull call spreads or the call debit spread. And this is a screen that came up. And for an April 3rd, we have a 305, 310. And if you click on that hyperlink right there, you bring up this risk graph page. And this was as a few minutes ago before Tom started talking. So I'm going to keep it consistent. It might be slightly different with the dynamics of the markets and such. But right now, folks, what do you think about this? A, you have to feel confident in Costco higher. if the coronavirus is spooking you to the point where you don't want to trade, you want to keep your cash on the sidelines, wait for this thing to base out, find its footing, we respect that. I'm not telling you to take this, but again, for educational purposes, you've seen how to go through Money Calendar, get your data, do your options analysis for what could be a low risk trade. And then if you like this, you're looking at a 305, 310. Where does the stock need to be at expiration to realize your full max profit? It needs to be above 310 at expiration, okay? And it's currently at 307.83. And if we get 3 points and change run, we're going to be just a bit over that 310. Now, we said in this marketplace, don't expect 100%ers all the time or as frequently as we did when the markets weren't crazy with the volatility. But here's one that shows 123 potential, and it needs to be above 310 because, again, you sold the rights for the markets to buy it from you at 310, and then you have the rights to go buy it at 305. There's your $5 difference in that execution of the strikes. So that $5 you make on the spread is offset by that 224 cost, and there's your 276 max profit potential sitting right there. If you like that one, you could at least save it in your Money Calendar folder and paper trade it. Okay. If you want to stand by, keep your cash on the sidelines, fully okay to do that as well. So I've saved it in the Money Calendar buy folder, and we'll see how that works out. If you want to go out to the April 17th and then just go edit and then change your expiration to the 17th and see what that comes back and looks like. Click update after you've done that. There's the information done. With your fast risk graph, it shows you multiple time frames between now and expiration besides the standard 4, or just click on the risk graph button again. And this one, it's a $283 cost, which means your profit potential isn't 100%, but it's still 76.68. Okay? You're not necessarily giving yourself more time. I mean, you are, but the end date that's analyzed for Costco is at April 3rd. So if you hold past April 3rd into the April 17th expiration here, you're doing so with 2 weeks where you don't have the Money Calendar analysis to show you what the price is doing over those 2 weeks. But that may be okay because you're not necessarily going after that 100%er. Let's say April 3rd, it still moves higher, goes up a point or two, and you're still going to make money on this spread. All right, so there's that. Now, Tom wanted me to show you ETF. So let's go to Tom's Tools again, click on Money Calendar. And you'll see here that Money Calendar has a arrow to the right of it. Left click on that arrow, and you'll see that the Money Calendar ETFs is right there. It does the same thing on the ETFs that we have in the directory. It's a proprietary list of ETFs that we have in here based off price, slippage, various factors. Okay, so let's go ahead and take a look. We're on the 9th today. So there were 20 and 19 of the 20 had a bullish move 9 of the past 10 years. So we click on that, double left click on your power meter, and there's IWM, the Russell 2000, URE, that's a 19-day, XLE 23, XOP, a couple of oil ETFs, okay? Now oil's been taking it on the chin. That's an understatement, right? Tom just showed you that he's looking at possibly adding a ratio spread on an oil stock, and I'll turn this over to him. But if you want some kind of like backing up of what the Money Calendar is saying, based off historical price moves over these periods of days, 9 of the past 10 years, these things have moved higher. We also have the bullish seasonal pattern. All of that's getting trumped right now by the coronavirus. And that's one of the things that the past 10 years, we haven't had a coronavirus in the past 10 years. So we can't say, you know, does this work because of the coronavirus? Some are working, some are not. All you can do is either keep your money on the sidelines or find factors that go into your rationale for a Money Calendar trade over and above, like we did with Costco, thinking that Costco is going to hold up pretty well because of what its industry is and the need for its products and such in this time of concern. So there's XLE, same thing. You're getting the same end date. You're getting the same average profit trade. Your accuracy 90%. You have to go 1, 2, 3, 4, 5, 6, 7, 8 years back before the only time it did not move higher over this date range. So Tom, I'll leave it at that. That's where you go to find the ETFs, and you can go ahead and do your same scans on your options analysis now. Do the searchers, multi-searchers, find trades, type in XLA and try to go with that. But rather than do that,
All right.
Tom, you've got a ratio spread you want to show them in one of these oil
Yeah.
stocks.
So
That's going to
right
take
after you started
on
talking,
what's
I
more
actually had a
important.
trade in the S&P that popped up. That was a
Okay.
bearish trade. And so it kind of moved really fast. It was a trade that, oh, let me just show you what I did, because I went ahead and put the stuff up to show you guys how this came up. So one of the things that we follow, and Jay, you didn't get into it, was the money clock. And so we have something that our partners have access to. I'm just going to share the screen with you right now. But what we look at is the ETFs. This was the morning. This is what I was trying to get into this morning, and I couldn't because it was just, we're coming out of lock limit right before 10 o'clock. And we had buy signals on SPY, QQQ, and DIA. And this actually went very well between about 10 to 12 o'clock. And then, of course, we saw the VIX that was coming in saying lower. I needed more than that. So then EWZ also had, so this was, the VIX was actually higher. It was saying it was going to go high from about 11:45 all the way out to about 3 o'clock, which is interesting because this is the time frame when all the margin calls all start coming for anybody that's, the large specs that have a little time to unwind their positions. They usually end up unwinding closer to the afternoon before 3. But notice this, we also got a short on EWZ at around 10 after 1. And then we had a short at IWM, which is the Russell. That came around 135. So what I did was I took the 3 of these together and I made a short because they're overlapping each other. So I'm looking at a short little trade that goes from the thinnest ones, since they're all overlapping. IWM lower, EWZ lower, and VXX higher actually. So this all goes out, and then we have this XBI out here that says, oh, we could go bullish. It starts its bullish pattern about 10 after 2. So anyway, I took the overlaps and I said, all right, I'm going to take this trade and I'm going to put this in at 135. And so I did. And so what I did was I used SPY because SPY has options that expire today. IWM does not. So I'm basically using SPY as a surrogate. And so here's SPY. This was at back up again, 135. So here's 135. And we went from 277.43 down to 276. We're starting to get a little bit of a rebound here, but I'm staying in this trade, win, lose, or draw, until a minimum. I have to stay in it at a minimum of, I could get out right here where this XBI starts to go bullish. That's about 210. But if I really wanted to stay in, I really should stay into about 240. So I'm going to show you how I flip the trade and make it a get out at 240. All right. So how I do that is this, and I just put a little trade on, like a 5 lot, nothing big. So if I go and find that trade, and so I can find that trade. Actually, I know what the trade is. I'm just going to put it in. So if I type in SPY, all right, here's the S&P 500. It was a put trade, and I bought the puts. So I have to sell to close the 5 puts that I bought. The puts that I ended up buying were the 278s. All right. Now again, I bought these in the 2s, so they're a little higher than they were. So just to get out of them at 240, what I'll do is I'll create an order. I can get out of these at the market right now. They're 3 by 310. But what I really want to do is I want to get out at the right time when the trade is over. So the trade is supposedly over at 240. So I'm going to do a market where I'm going to place a market order to sell these to close. But I'm going to do an advanced order, and I'm actually going to, the market order is going to go out at precisely 240. So depending on what broker you use, this one, this is Schwab, and so they use a what's called a contingent on time order. So I can set this for 2:40 p.m. I can set that trigger, And now I've set the trigger. It says this: sell the close by 278 puts at the market at 2:40 p.m. Preview it. There it is. All right. Place the order, and the order is now submitted. Now this is in and it's ready to go. All right. So now I want to show you the. So that was the SPY short-term SPY bear trade. The other thing I was looking at was an oil bear for the next 3 to 4 weeks. Now I put 2 of these on. I didn't think I was going to get filled that fast, so I put it on while you were talking, Jay, and I got the proverbial ding. So let me show everybody what that is. So I'm looking at an oil bear for the next 3 to 4 weeks, and what I'm looking at is this. This is a put skew chart for oil. They all pretty much look the same, where oil right now, a USO, is trading around 7. So this would be where we are on the screen. So the thing is if you go the higher strikes, what happens is they get cheaper in implied volatility, and as you get closer and closer to 0, they get more expensive in implied volatility. So what I want to do is I want to buy the low IV and I want to sell the high IV, and I want to take advantage of the skew, which is actually happening today. All right, so to do that, what I want to do is I'm going to, let's go to the tools first. So let's slide over and look at our tools. And our tools right here, here's my stock chart. Here's USO. We know the USO is, has taken a big dive. Let me bring the latest chart up. And you can see it hasn't really moved much in the last half hour. So this is USO. And more importantly, we see high IV. So we want to do something that includes selling some implied volatility because IV's gotten so high. Now, what we could do is, here's my USO. This is the option chain for USO right now. Now, I could look at the March, the ones that expire in 4 days, but this isn't going to be a 4-day move. This is going to be something that's going to take some time. The 4-day move happened already. That was this morning. That was last night. All right. That was a move where if you put it on Friday and you happen to be bearish, great. And if you happen to be bullish, you would have lost money. But now what I'm looking at is something that might transpire over the next 2 to 4 weeks. So to do that, I need to be looking at not today. I need to be looking at maybe the end of March or the beginning of April, or even the 9th. Let's just look at these, the March 27, the April 3rd, and the April 9th options. We'll take a look at those. And I've got these spread out enough where I'm looking 50% above and below where the stock is priced at right now, which is very close to 7. Now, I could buy a put. Let's go look at long term. Let's go all the way down. Let's look at the April, the April 9th. They're really not long term. It's 31 days from now. If I bought the 7 puts, which are the at the monies, all right, let's take a look at that. The 7 puts are going to cost me just $82, but that's 82 cents on something that's trading at 7. That means in order for me to break even within 31 days, I have to have USO move lower, and it needs to move down to where? $6.18 in order for me to break even on the trade. Then if it moves lower, I make money. Now, if you believe oil that USO is going to go to 5, this makes sense. If you think it's going to go to 5 in 31 days, I don't know. I also know that if I'm going to take this trade, maybe I'm going to be looking at 50 contracts. And this is just me. All right, so now let's look at it in 50 contracts. All right, so I'm going to risk $4,100 on the trade. I'm actually going to pay $4,100 on the trade. I can make a maximum profit of $30,000, but oil has to go to 0. Now, there's one thing that I have never seen happen before in my life, and that is the price of oil go to 0. I've never seen it happen. I doubt it ever will happen. In fact, there are prices of which, if we get down into let's call it the 20s, people will stop pumping oil. In fact, at the prices we're at right now, if they don't pop back soon, oil shale companies will stop drilling for shale. They'll stop doing it. It's cost too much money for them. So, to me, this does not look like a good trade because the downside break even is too low. All right, I mean, we're talking about something you have to go 10, 15%. You have to go 15% below the 30% that we had today, or 25%, in order to be at break even in 30 days. I don't see it happening. The probabilities are low. So what I have to do is I have to get this break even closer to where we are today. Now, there's a few ways I can do that. Step one, I can go back and I can create a spread. So maybe buy the 7s, sell the 6s. All right, so a 1-to-1 spread. 1-to-1 spread is going to cost me $37. So now instead of paying $8,200, all right, or $82 per contract, I've now more than reduced the cost of this in half. I've got it down to a level of 6. All right, and I brought my break even from $6 and what was it, 17 cents to $6.63. So we don't have as far to go to be at break even in 30 some odd days. Now, is there another way we could do this? Yes, it is. What we could do, go back to the table again. Now remember, it's all about risk, reward, and break even. Now, what we could do is, if we're bearish, we want to take advantage of volatility, I could sell the 7 calls. Now, if I sold a 7 call option, that means that I have, if it just stays at 7, I make money. But what happens if it goes up? I have, if the call just stays where it is, or even goes lower, I can make, what is that? I can make $80. But I have a maximum risk. This says 6,220, and I don't even think that's correct. But let's just all say there's a lot of risk on the table. All right. What I could do to take advantage of probability, to take advantage of a potentially lower move, but also get my break even in line, is I could do something called a ratio spread. A ratio spread involves back to puts again. I would be selling more puts than I buy, knowing that the floor is 0. So for instance, I could buy the 7 put, sell the 6 put times 2. So for every 7 I buy, I sell 2 6s. That's going to cause a risk trade as well. But keep in mind, now what have I done? I put the trade on, and again, I'm selling for 45, and I'm times 2. That means I'm going to sell. I'm going to bring 90 cents in on the 6s. I'm going to pay 82 out on the 7s. So I'm basically putting this trade on for free. Free cost. But what's my risk? My risk is if oil goes to 0, I could lose $492. However, if it goes to 6 in 30 some odd days, I can make $108 per spread. All right. Now let's put this into Tom perspective. 50 lot. Actually, I better make this 100. And I'm going to sell 200. Now, what I'm looking at is an $800 credit. Basically, I keep that if it stays where it is or it goes higher. If it goes down, the most I can make on the trade is 10 grand. If it goes way down, the most I could lose is almost 50. So I have a situation here where my maximum risk to my maximum profit potential is what? It's about a 5-to-1. Does everybody see that? I could lose 5,000 or $5 for every $1 I potentially make. But in order for that to happen, what does oil have to do? It has to go to 0. USO has to go to 0. All right, so let's change a couple of things here. Let's bring the lower side to 0. And let's look at this. Let's take a good hard look at the worst case scenario. There it is. All right. Now that we got that out of the way, is oil going to 0? Probably not. Could oil drop another 50%? Very low probability, but it could. All right. But could it drop another 30%? Yes. Where's 30% on this graph? Take 7 and divide it by 3. And what you have is about 2 1/3. So that would take us down to $4.66, which would be right here on the risk graph, folks. Let me get in there so you can see it. So there's a $1,500 loss if we go down 30% in 31 days after already dropping 30%. Here's what I see with a trade like this. You got to go up a little before you go down in the 30 days, all right? And if we go below, let's call it 6, maybe I pull the plug. And if I pull the plug, I might be at break even, all right? But I could use that as a stop. And if I use that as a stop, if we go to 6 tomorrow, it looks like I lose about $1,500. But if we go to 6 with 11 days to expiration, I make $2,500. And the sweet spot, obviously, which is also a low probability that we're going to hit 6 on expiration day, but it's a possibility. All right. So how could we lower the risk of this trade? We could do a butterfly. Yep. We could do a broken wing butterfly, where maybe what we do is we have 1, and then we have we have 2 over here. We could put a 1 way down here at 4, and it would cut that off, right? And then we'd have a limited risk at 4. That's a possibility. What would that look like? All right, well, let's go look at it. So in this case, I'm long 1, I'm short 2, but then I could be long 1 down here at 4 to cap the risk. There you go. Now your trade looks like this. You're still doing this for about $3. All right, you're still doing it for almost nothing. But what you're doing is, and yeah, it does bring the break even down a little bit, but we've capped that loss to the downside. All right, that loss does come down, and it still ends up. Now look what happens. You make yourself almost a 1-to-1 reward to risk position. You do it with very little debit. All right. Now, how do we put that trade in? Put it in as a butterfly. Let's see what it's even doing right now. All right, so this looks pretty good. This is a broken wing butterfly, right, or a modified butterfly, where we're modifying the actual buy to sell to buy down here. So we're 1 point between the buy and the sell, 7 to 6, and then we're 2 points before the coverage, right, that catastrophe coverage. How does that look? Come on over and let's create a trade. Let me put in USO. I've already done a few ratio spreads, so what's one more? We'll do a butterfly though. Look at a butterfly. This is using all puts. So I'm going to change this as all puts. Put butterfly. Now, we could do it's possible that, you could look at something that may not fall as much between now and expiration. If we sold the 6.5s, we bought the 6, we bought the 7. What could we do that for? It looks like 7 cents. 7 cents to make, okay, let's call it 10 cents because you're not going to get 7, but you might get 10. You're risking 10 to make 40. Where is USO right now? That's the big thing. Where's USO? Let's go look and see where USO is. USO 672. I mean, it's well within. See, by doing this trade right here, oh, that's looking nice. By doing this trade with a 672, you're already halfway to the distance of the goal line here. So this might be a very interesting trade. So again, and we're looking at, this is 313. This is Friday. Are we going to be at 650 on Friday? This is a really good trading opportunity. All right, so let's find out how much this is going to cost us. So if I did, let's say 50, sold 100, bought 50, what could I do it for? 7 cents, 6 cents, 7 cents. All right, what am I going to do? You know what I'm going to do? I'm going to try something here. Let's do a walk. This is, first of all, this is a debit. This isn't a credit. This is going to cost money. All right, so we're going to have to do a limit, but we could do a walk limit debit. What that does is that starts us off at 7 and I work my way to 9. I like that. So 7 to 9. All right. So what's this going to end up costing me to do this whole trade? It's 9 cents. So now if I'm doing, this is basically a 50 lot, the way this is done. So before I do this, I've got to preview it, find how much it's going to cost me. This is going to cost me, the estimated total is $450. All right. It's $100 in commission. But again, I'm looking at this, I can put it on for 5,000 to make 4,500 is the possibility. All right. And I'm going to cancel this for a moment because I want to take a good look at this. Right. Maybe what I do is I start at 6 and I end at 8. All right. I don't want to trade. I don't want to pay more than 8 for this thing. What does that do for me in terms of price and et cetera? All right. I mean, it still brings it at 507, and that 507 is based on, it looks like based on the 6. But you know what? Let's go ahead and try this. So I'm going to place this order. Remember, what I'm doing is I'm buying the 7 put, selling the 6 half, and buying the 6. So I have 50 cents of potential reward minus my cost. All right, so this is in. Right now I'm at 6, paying as much as 8. Nobody's taking my trade. All right, so it's sitting there right now. No one's taking the position. We'll see what happens here within the next few minutes. Maybe I might want to go out there and I can't modify. You can't modify a trade like this. You either cancel it, replace, or you just go with it. All right. So I'll cancel it real quick because I want to see what's happened. That ding means I canceled. Okay. So I can check my order status. There it is down there. If I click on it, just brings it up and shows me what I tried to do. All right. Now, let's go to the ticket once again. Let's try again. USO. Jay, you having fun watching this? Again, 7
Trying to write it
half,
all down
7
as fast
6.
as I can.
7 half. Remember, we're doing puts, and I want to be below the market. So I want to buy the 7. I want to sell the 6 half. I want to buy the 6. All right. Look what happened. It went to 10 cents. So I can't do it. They weren't letting me do it at 8. All right. So what I want to do is I want to go back and look and see, well, this is why, because it's dropping even more. All right. So now I'm taking a look at this saying, all right, we just hit new lows, didn't we? Did we just hit new lows in oil? We did. The new low is 664. It took out the low here. That's what I think what's been dragging the market down as well. All right. So let's take a look and see. And I mentioned this morning, and unfortunately, all of you on this call right now didn't hear this, unfortunately, but I said that right after the limit orders were taken out, it would not surprise me if they take this thing down again this afternoon for margin calls and go through those limits. And we're down 7.5% on SPY, but yet we have not hit the low for the day because the low is 273.5. We came all the way down to a little bit above 274. It's popping again, but for how long, we'll see. Let's go back again and look at this order. Now it's 7 by 11. So, I mean, technically, if I really want to try to pay, maybe a little bit more, that now we're at 9, okay? Now we're at 9. So maybe I put the order in and I do a credit of 9. Or I'm sorry, a debit of 9, not a credit. A debit of 9. 9's not bad. What's that going to cost me? Let's look and see. Oops. That's a 1. I'm like, wow, that got really cheap. No, it got cheap because I didn't put the rest of my order in. 50, 150. Now, again, let's go back to 9 again. 557. I mean, now we're kind of, I like it at 500 or less with the commission in it. And so, if I go down here and I put it at 8, maybe it gets filled at 8, but I think with the with oil dropping the way it is, not going to happen. But I mean, now I'm close to make 4,500, risk 500. on a butterfly, which is, you got a lower probability of actually hitting that thing. But let's see. I put it in at 8. I'll leave it there. Let's see if it gets filled. I'm going to actually leave it there for the next, the rest of the day. All right, because I like it at that price. So based on, and what's it based on? Based on what's happening right now. I mean, we're at 660. We're on the lows right now, and oil is going to push the market lower. It just will. That's what's going to happen. I mean, we're trending back to the red line today. So there's where we are. Let's see what else is happening here. Jay, questions, comments? I'm sure you got tons of them, so let's hear it.
Actually, not as many as you think. Jim's asking the question, even though oil can't go to zero, could the ETF go bust somehow?
Now, what the ETF could happen, what could happen is that the managers of the ETF could do a reverse split. And if they do a reverse split, that'll reverse it. Let's say they did a 2-to-1. That would take this price up to 13 and change. But my options would also do a reverse split up as well. We've seen this happen in the VIX or in some of these VIX traded symbols for a while before some of them just kind of went kaput and they delisted them. But yeah, I mean, that is possible because this is a managed ETF. But again, before it would go kaput, because USO is not leveraged, it's not a leveraged ETF, so that's good. It's got that good thing going for it. But what it could do is it could very well do a reverse split, and they'd reverse split the options along with it if that did happen. 23% down on the ETF today. That's something you just don't see. You don't see these kind of things happening all the time. All right, so I'm submitted, still hanging out there. Let's look and see where it's trading at right now. So let's see, order status. And I mean, I've got all these kind of going on. So my spiders have doubled. My spider puts doubled in value already.
Yeah, over 2,000 down, so that's helping that position.
Yeah. Oh, is it down 2,000 again? Wow.
Becky's asking.
I mean, I can't look at it all at once because I've got the webinar going. So,
sure.
But yeah. So, and I got a couple of these ratios.
If the Fed lowers rates again, will the bleeding stop? Mm-hmm.
I think what's going to happen is you'll get a jump up, and then I think we'll kind of consolidate back down if the coronavirus is the front and center and not oil. Today it's a combination. It's like the perfect storm that's happening right now. But again, I'm like a lot of you. My overall account is down, but I'm happy that the majority of my overall account was in options because I'm down like 1% when the market's down 5 or 6 today. That's where I am as far as my account. So I'm maybe 1.5% now. But I mean, that's where I am, and I feel good about that because I'm mostly in cash, and I'm sitting in with dry powder, and I'm waiting, and I'm not going to go start buying stuff today because I don't know where tomorrow is going to hold. But I do think that that the worst of this I think is going to be behind us after this month. So what do? I look for like for instance Costco, Walmart, Walgreens. These are things that look for stocks to go up in a down market. And I'm looking for value, but it's just hard to find value when you know that the reason value is there is because of the impending problem we have. And the fact that oil, I have a bearish outlook on oil right now. And I should because of what we saw here. But, because of my bearish outlook on oil, I have to maintain some sort of a neutral outlook on the market. So I'll buy some quality and I'll look at options, and I'm looking at selling strategies right now. I'm looking at the minimum spreading. The only reason I'm long these puts is because I know I'm going to be out of them in about 25 25 minutes. Yeah, 25 minutes I'm out of these, win, lose, or draw. Right now it seems to be a winner. But I believe that we still have more of these people that are got to make this decision to get out of this thing before we get to 3 o'clock. So that's why I believe that this is going to continue. And I haven't even looked at bonds. I haven't looked to see if bonds went green or not, but let's take a look and see. No, not yet. but they're getting, I mean, they made that rally up, and this, this wasn't what got me excited about getting short the market. The reason I got short the market is because I had a signal. The money clock was consolidating, saying VIX is going up, and these are now going into their short window. So I just did some stacking, and that stacking seemed to make sense. All right. Any more questions, Jay?
No, sir.
All right. Well, I mean, we talked about placing orders. I showed you guys how to do a time contingency order. We did a butterfly spread. I tried to do it with a walk limit. It didn't fill. So then I just went ahead and stuck my limit back in there. I'm going to hang on to that for now. So that's where I am with that trade. So I think we're at a stopping point right now for today. So tomorrow, what I want to talk about with you guys tomorrow. So we're going to, again, go through the market order. We're going to talk about, again, spotting rules-based opportunities. We're going to create low-risk trades. I do have a really interesting setup that's coming later in the week that I'm going to share with all of you. A short-term trade. I'll know more about it as we get into Wednesday. But the one thing I saved from talking about today was calendar spreads. Calendar spreads take advantage of this high volatility situation that we're in right now, and we can do it as a delta neutral trade. All right, it has some qualities that a butterfly has, but it also has some qualities that a butterfly does not have. So we're going to get into the calendar spread tomorrow, and we're actually going to talk about what it is. We'll break down the rules. We'll spend a little bit of time on that strategy tomorrow. So I hope you can join me tomorrow. We're going to be doing some live trading again tomorrow if something presents itself. As of today, it looks like if I were to take my SPY trade off right now, I mean, it was at a double. I'm thinking I'm going to hang on to that and let that go into the next few minutes and see if that was the right call or not. I'll let you know tomorrow how that ended up. As far as our oil trades, those are on for a few weeks, obviously. So those are going to be something that's going to, work itself out over the next few weeks. All right, but join us tomorrow because we definitely are going to be discussing those calendar spreads as well. I got a recording to go out to you shortly. If you had any questions that you didn't think about regarding the webinar, regarding what we did today, or even that have to do with our tools, then you can email us, support@tomgentile.com. Otherwise, you know where to subscribe if you're interested. Thanks for watching, everybody. Thanks for joining me. We'll see you tomorrow, same bat time, same bat channel. Have a great afternoon. Stay safe, and I'll see you tomorrow. Bye now.